Good evening, everyone. Thank you for joining this evening's Corporate Connect featuring Elite Commercial REIT. This webinar is organized by SIAS and supported by SGX. We will kick off tonight's webinar with a presentation by Mr. Geoff Howie, market strategist from SGX on recent market highlights, followed by a corporate presentation by Ms. Xiaodin Wang, CEO of Elite Commercial REIT, and lastly, a Q&A session moderated by SIAS. Now, for those of you who may not know, Elite Commercial REIT is the first and only UK-focused REIT listed in SGX on 6 February 2020, with portfolio comprising of 155 predominantly freehold quality commercial buildings located across the UK, and over 99% of its portfolio is let to the UK government. Ms. Xiaodin Wang will be sharing more about the REIT during her presentation later. Now, without further ado, I'd like to invite Mr. Geoff Howie, market strategist from SGX, to kick off the session for tonight. Geoff, over to you. Thank you.
Thank you so much, Zach. And I really look forward to this just very quick 15-minute session or so, just to run through our real estate investment trust and I guess provide an educative overview of what's been happening in our market so far this year. So real estate investment trusts, if you're new to this, they are funds that really invest in a portfolio of income-generating real estate assets, and that can include things such as shopping malls, offices or hotels, industrial parks, and so forth. That's predominantly the bell curve of what the majority of global REITs that have been around for a good 60 years or so, mostly in the US, are actually investing in. Now, these REITs are set up with a view to generate income for the unit holders of the fund, and they are the unit holders are the actual investors of the REITs. So for the past 20 years, since 2002, Singapore has actually grown to be one of Asia's largest real estate investment trusts and property trust markets. As of the end of March, the combined market value of the S-REIT sector in Singapore stood at around 116 billion Singapore dollars, and that represents around 13 to 14% of the combined value of all stocks that are listed for trading on Singapore Exchange. As many of 18 of these trusts actually invest in property assets outside of Singapore exclusively, one of which is here tonight, which we're looking forward to hearing more from. And we have 19 of our trusts that are actually investing in properties in both Singapore, and then we have 5 REITs that are investing purely within Singapore. Now, this includes as many as 10 trusts with properties in China, 8 REITs with properties in Japan, 6 REITs with properties in Malaysia. So there's a very strong pan-Asia focus, but more recently, there's a very strong global focus, as we'll hear more of on soon. The trusts, I should also mention, they are also highly diversified across property types with a balance across retail, industrial, office, and hospitality properties, in addition to multiple REITs that are investing in healthcare-related properties and specialized property assets such as data centers. So the combined market value, as we said, is 113 billion Sing dollars, and that combined market value has grown at a 13% compound annual growth rate over the past 10 years. And it's not just down to performance of REITs, but portfolio growth through acquisitions that, among other methods such as debt, can be funded through secondary fundraising such as placements and rights issues. There has been a clear industry drive to increase unit holder value over the last few years, and that can entail divesting, recycling, or acquisition of properties. And we saw close to half of our S-REITs, over half of those 40 or so S-REITs, announce asset acquisitions last year valued at more than 12 billion Singapore dollars in total purchase considerations, with the acquisition drive also continuing in the first quarter of this year, with Cromwell European REIT, CDL Hospitality REIT, CDL Hospitality Trust, I should say, Maple Tree Logistics Trust, Lend Lease Global Commercial REIT, Ascot Resident Trust, and CapitaLand Integrated Commercial Trust announcing acquisitions in the first quarter of this year. So globally, what's happened, I guess, this month is it's been a more volatile start to the first quarter earnings session than normal because of these two overarching drivers, that is really decelerating of growth and increased inflation, which has been exacerbated by the Ukraine crisis. So what we've seen is, so in April, agriculture, food, utilities, energy, airlines, and REITs have been among the most defensive sectors this month, with technology sectors such as semiconductors, internet, electrical components, actually the worst performing sectors. So REITs has actually been one of the most defensive global sectors so far this year, or so, not so far this year, but really in the month of April. And it's really come down, as we said, to the developments and the challenges in the global macro come along with these global macro drivers. So what's been supporting REITs and airlines is really the global reopening theme. So the smooth number of new daily confirmed COVID-19 cases has really more than halved just in the last 29 days. So smooth daily global COVID cases was up at 1.5 million cases on the 31st of March, and that has since fallen to below 700,000 as of yesterday. So that really has supported global airlines, and it has supported global REITs. Now, what's been interesting is the rotation within the REIT sector. So the reopening theme has seen hospitality REITs lead the global REIT sector over the first 4 months of this year, while data center REITs have been the underperformers after the reverse actually occurred in 2020. That was data centers at the top, the hospitality REITs at the bottom. So that will also occurred also in 2021, albeit to a lesser degree in 2021. So we've seen the reverse now. Now, we're in the midst of the earnings season as well. So we've had around, I think, 20 to 25 S-REITs and property trusts have already reported their financial results or business updates for this reporting season. And all the pure play hospitality REITs with Singapore assets have reported. They are Ascot Residence Trust, CDL Hospitality Trust, Far East Hospitality Trust, and Fraser Hospitality Trust. Now, those four have averaged, as of yesterday, I think around 23% total returns in the year to date. Most of the hospitality trusts with Singapore assets reported higher revenue per available room in the first quarter of this year due to growth in the average daily rates and occupancy. So those trusts also expressed optimism for 2022 as they see recovery and reopening across their operating markets. Elsewhere in the world, according to the Microsoft Annual Work Trend Index report for this year, 50% of business leaders are saying their company already requires or plans to require full-time persons working in the year ahead in the offices. So that's this is now looking at the US. So companies such as Apple, JP Morgan, Twitter, they are said to be welcoming more staff back to the office and also consider hybrid models. So we list 3 pure play US office REITs. I think it's Manulife US REIT, Prime US REIT, and Capital Pacific Oak US REIT, which have been taking their cues from those developments. And then across the pond, we have Elite Commercial REIT, which is also listed here, and it invests in commercial assets and the real estate related assets that are in the United Kingdom. And it is also our only UK focused listed REIT in Singapore. So interest rates have been getting much attention, obviously. They have always been a key driver for the sector, given the impact on yield spreads and borrowing costs. But S-REITs have been actively managing their interest rate exposures. So on average, close to 75% of the S-REITs' current debts are actually entered directly into fixed rates or hedged through floating to fixed interest rate swaps. Now, S-REITs currently have an average gearing ratio of around 37%, So that's based on filings and well below the regulatory threshold of 50%. And it translates into approximately $25 billion of potential debt headroom for the sector to fund capital-intensive acquisitions, basing it on some Bloomberg data that where you basically take the total assets and multiply it by the company reported gearing ratio. But nonetheless, as of the end of March, the FTSE ST REIT index, it maintained a 290 basis point premium to the Singapore 10-year yield average of 395 basis points. So, average versus 10-year average of 395 basis points, I should say. The yield spread was at 287 basis points, a little lower than the actual 395 basis point average over the past 10 years for that yield spread. So on the whole, global REITs, they do have a track record for being defensive in nature. Of the 800 or so REITs listed across the globe that have performed comparatively well in terms of yield and volatility and NAV over the past 10 years, that has basically, those past 10 years have actually spanned broader market ups and downs, which has also included interest rate cycles. So for the current interest rate outlook, you've got the CME FedWatch based expectations that the US rate target band will be at around 275 to 300 basis points following the last FOMC meeting of the year this year in December, which is quite a significant increase. There's currently a Fed blackout period because our next FOMC decision is on the 4th of May, and expectations for a 50 basis point hike on the 4th of May to the 75 to 100 basis point band, they're currently at around 97%. And the rebalancing from the consensus expectation for a 25 basis point hike has gradually increased through March and April. So the big overriding theme has been that reopening, particularly here in Singapore. I'm just going to flash up this page here. I've just taken this page right now from Bloomberg, and it's just showing you. So as we said, there's 800 REITs across the world. These are the close to 300 REITs that are listed across Asia Pacific. And when you look at the REITs that have led, so on a median basis, REITs across APAC have returned a 3% decline in total return. But when you look at the REITs that have been outperforming, you've got Fraser Hospitality Trust right at the top, Suntec REIT, CDL Hospitality REIT, Far East Hospitality Trust is here. So you've got 4 of the 6 best performing REITs listed across APAC this year so far, basically listed here in Singapore. And as we said, related to hospitality. And here you can see Ascot's down here as the 13th strongest REIT so far. So that's just taking a snapshot now. But the key overriding theme has obviously been on that reopening. Cases have come down significantly, and the severity of variants has not got much worse. So that has been a key driver in our sector. But I should also mention, because I've got a couple of minutes, I just wanted to mention also interest rates, because I said they're very relevant for REITs, but they also very relevant for the trio of banks, DBS, OCBC, and UOB, which account for more than 40% of our STI. And DBS and OCBC reported that their net interest margins were up 3 basis points quarter on quarter for DBS, up 3 basis points for OCBC, and up 2 basis points for UOB. So banks globally tend to maintain positive correlations in their net interest income and net interest margins to US interest rates. So the textbooks and so forth might talk about how the interest rates on the treasuries compete for the investors' income, for the investors that are looking for yield in the REIT market. There's also a pretty big significant impact on the banks. For instance, the CEO of DBS maintained again today that the net interest income sensitivity of DBS is around 18 to 20 million Sing dollars per 1 basis point of US dollar interest rates. So really, in conclusion, we're having this mixed earnings report at the moment. This process where we're seeing the FTSE All World Index has been much more volatile than it usually is at this time of the year, because you do have those overarching drivers of decelerating growth and higher inflation. And you've basically got the STI up 8% so far this year versus the All World Index, which is down around 8% so far this year. So plenty of volatile moves that have been in play. But as we said, we're in the midst of earnings. We're not there yet, not complete for the REIT sector. I think next week we have business updates or reports from REUS Hospitality Trust, Ascendus REIT, Lendlease Global Commercial REIT, Fraser Logistics and Commercial Trust, as well as First REIT. Then the following week after that, you've got Manulife US REIT, Prime US REIT, Sasso REIT, Daiwa House Logistics Trust, EC World REIT, OUE Commercial REIT as well, I think, and United Hampshire and Cromwell European. So as we said, we're right in the midst of earnings. And yeah, the market has been swinging more than it typically does in these last 2 weeks, which is very important globally for earnings. And as we said, that's really put down to the current outlook for growth as well as interest rates. So I'll finish right here, Zach, and thank everyone for your time tonight. And I look forward to the next presentation with Charlene. Thank you.
Thanks so much, Geoff. All right, next up, we would like to invite Ms. Sheldon Wang, CEO of Elite Commercial REIT, who will be doing a corporate presentation on Elite Commercial REIT's business insights and updates. Ms. Wang, over to you.
Right, thanks, Zach. Yes, and also thanks, Geoff, for the exciting introduction earlier in terms of the market. Well, good evening, ladies and gentlemen. Thank you for spending some time with us. Yes, we also just made our results basically our business updates announcements this morning. So it is also just in the middle of the results periods. So let me just quickly run through the presentation today, and we will try and address as much questions that you have later as possible. So I guess it has been mentioned earlier, Elite Commercial REIT is the first and only UK-focused REITs listed on the Singapore Stock Exchange. We managed to get listing done just right before the onset of the COVID pandemic 2 years ago. So today, we have now increased our portfolio size last year to 155 office assets in total. So at the end of the last financial year, the valuation for the portfolio stood at £500.1 million. And our assets are very well located across the whole of the UK. If you look at the map here, you will see a lot of little dots, and that's where all the assets are located. Now, over 99% of our properties are let to the AA credit rated UK government. I'll go a little bit more into the details on that later. The portfolio itself sits on 97% of them sits on freehold land, while 3% actually sits on long leasehold. And all our leases are on full repairing and insuring basis. In Asia, we commonly term that as a triple net. And the majority of them actually come in with built-in rental escalation that is linked to the CPI index. But there is a floor and cap to it, which is 1% to 5%. So the rental escalation rate has already been compounding every year for the past 4 years. So it will compound for 5 years. So starting 1st of April 2023, we will see the new compounded rental escalation kicking in into our portfolio. Can I have the next page, please? So like I said earlier, we have just announced our business updates. So this is just the summary of our first key highlights. The key focus for the quarter was to complete the very positive lease regearing exercise to ensure that we have lease stability and income visibility for the REIT for the next 6 years. So in line with that, we also have embarked on a sustainability collaboration with our key tenant, which is the UK. I'll go into the details later on that sustainability collaboration. But I guess next page. On the numbers front, Our distributable income generated during the period has increased by 36.2% comparing to the same quarter last year. And our DPU has also increased by 4.69% in the same quarter reported last year. Next. And our revenue, sorry, previous page, please. Oops, okay. So the revenue numbers stood at £9.2 million as compared to £6.6 million reported last year. This is mainly due to the maiden acquisition, which we have completed during 2021. And the DPU is recorded at 1.28 pence for this last quarter. Next. A summary of our balance sheet. I think our assets stood at £527.8 million at the end of this 1Q. It is slightly down from the number that we have reported at the end of the last year. Well, the key reasons is actually with regards to the retained earnings. So for this quarter, we have 3 months on retained earnings on our books, whereas when we were reporting in the last quarter, it was for 6 months. So that is the slight difference in terms of our total assets. And our NAV per unit stood at 59 pence. So maybe just before that, sorry, yes. So the manager intends to conduct a mid-year valuation exercise this year to update the REIT's portfolio value, because we did a very major re-gearing exercise, and that should have some impact shown on the non-current assets line item on this balance sheet. Next page. So this chart itself shows the debt maturity profile of the REIT. We do not have any loan maturing this year, but we do have loans coming up for expiry in the following 2 years. Our total debt stood at £225.6 million. Gearing ratio is at 42.8%. Our borrowing cost is approximately 2.1%. And the interest coverage ratio for the REIT is 5.8 times. Now, our interest rates exposure are fixed for 63% in the portfolio. So I guess the gearing ratio will show a difference, or will show some impact after our mid-year valuation, and that should be reflected accordingly. Next page. Yeah. So currently, 100% of our portfolio that we reported are actually occupied. And then the WALE of this portfolio is stood at 5.5 years. Now, we have been very proud to say that since listing for the past 8 quarters, we have always been reporting a consistent rental collection 3 months in advance from our tenant. So we have now already collected the rental for the next 3 months up to June 2022. This is definitely due to the AA credit rated tenant that we have as a tenant for the REIT. Next page. So I've mentioned earlier about this lease re-gearing exercise. So we do have a large number of assets that has got a break options coming up in 31st of March 2023, which is next year. So in line with that, we want to ensure that the tenant could remain in most of the assets for a longer period of time. We started negotiating and discussing with the tenant on the needs of the assets in our portfolio. Now, through the hard work from the asset team, I think we are very glad to say that out of the 117 assets occupied by DWP that has got these break options, they have confirmed that 108 of them will remain until 2028. So break options has been removed from these leases, sorry. And there is one property which is let to the Ministry of Defence. Similarly, that break option has also been removed. So out of 109 leases, 18 leases, we have 109 of the lease breaks option removed, confirming them to run all the way till March 2028. That actually allows us to have the lease stability and income visibility over a much longer period of time. Next. Okay, so on the lease breaks options notice that were received for the remaining 8 properties that the DWP has been using. That represents about 4.8% of our contractual rental for this year. So DWP will move out of these 8 buildings by the end of March 2023. So they're currently still income producing, and the manager is actively looking into the asset management work for this assets, and are coming up with plans to ensure that they will provide a better return for the REIT itself. Now, there is one more property that DWP is still considering. So until the decision is made on this particular asset, we will come back to the market to inform investors on what is the decision on that last property. So apart from these, there is no further break options available inside the portfolio that's led to the DWP. Those that are no break notice has been served are now all confirmed to expire only in 2028. I think the bottom chart of this chart shows Sunderland and also Dundee building. This is what we have reported previously last year. So currently, we are actually actively marketing on reletting of this true property as well. Yes, thank you. So the 8 properties that I've mentioned has got a 12 months notice period. So which means that we have now slightly about a year before they will really vacate the building. Managers is evaluating all options and will formulate the strategy accordingly, because each of these buildings are located in different parts of the UK, different cities or towns. So depending on the attributes of each of these assets, potentially it could be relet as office space. It could be considered for disposal for us to recycle some capital, should that possess as one of a better options. Or we could also be looking at seeking consent for alternative uses for conversion of these assets as well. So next page. So with this particular exercise completed, now what we have seen is that previously in 2023, there was a huge tower of potential lease to break. Now that has been removed, and we have now confirmed 85.2% of the REIT's total portfolio annualized GRE is to run all the way till March 2028. But however, manager is cognizant that the lease expiry concentration in 2028 is in a huge tower now. We are working to stagger this going forward, and that is the aim and one of the objectives of our asset management work as well. Next. Right. I guess this is inflation is not something that is actually foreign to anyone here, and particularly with the constant news recently. Inflation has been growing in the UK. It has been reported high inflation, especially recently. Now, the impact to us is that because our rental escalation is pegged to the CPI index, our rental escalation is actually compounded based on the actual prevailing CPI that comes in. So like I've mentioned earlier, we have a floor and cap of 1% to 5%. So that will kick in next year. I think in the next page, I will show a little bit more details in terms of numbers on how it should impact us and will impact us. So I think we have announced this after we completed the lease re-gearing exercise. The assets that we are referring to here in this particular table is 147 assets in total out of the 155 in our portfolio. And these are the assets that were let to the Department of Work and Pensions and the MOD. So currently, based on the contractual rental income for this year, we see that there is 34 million of rental income collecting from this pool of assets. Now, over the past 4 years, we have locked in close to about 10% of rental uplift already, and the final rental escalation will depend on this year's prevailing inflation rate. So we do expect that based on the formula in the lease agreement, we will be looking at a minimum rental escalation between 11% to 15.4% come 1st of April 2023. So in this particular table, we have ignored the rental coming in from those assets that the government has served the break options. So which means that, if there are further income coming from reletting to other tenants, it will increase the rental income for the REIT further. But based on even this particular situation where we have taken into account the break options being exercised on those assets that I've mentioned earlier, we are definitely looking at a rental income that is stable or much better than what we are reporting today. Next page, please. A little bit more on sustainability. I think this year we have actually reported on our sustainability arrangements in our annual reports. So in our case, because all the leases are let to the tenant on an FRI basis, the tenant has the right for quiet enjoyment on the assets, and we don't have the ability to go in and move it and do whatever changes to the buildings that we want to anytime, that we deem is fit. So that is only opportunity only arises when the properties revert back to us. Now, the manager didn't want to sit around and wait for things to happen. So what we have done is we actually managed to have a breakthrough with the government departments and formalize a sustainability collaboration with both the DWP and also the Ministry of Defense on the buildings that they are using. So the aim of this collaboration is to ensure that our properties will remain relevant for a longer period of time, and that should enhance the long-term value of Elite Commercial REIT. This is also in alignment with what the UK government's commitment to achieve a net zero carbon emission by 2050. This innovative initiative that we've come up with the government, I think is probably one of its first in its kind, will allow us to work very closely with the departments, and we are having regular dialogues and meetings with the tenant to understand what they are doing with the buildings. So in total, we have committed an aggregate of £14.8 million over a period of 3 years towards pre-approved works on the buildings, on our buildings, that is actually led to the two departments. The asset enhancement work that we are looking at is going to improve the property's energy efficiency, and hopefully that will bring about an increase in the EPC ratings for each of our buildings. Next page. So like I said earlier, we have already published our inaugural sustainability report together with our 2021 financial year annual report. And this is in line with, and it is in it actually outlined our sustainability strategy, the framework, how we actually engage with the stakeholders, any material topics and targets that we have. And we aligned our reports to the global reporting standards, because we are not only looking at just Singapore, we are also looking at the requirements in the UK. So we are reporting in line with GRI and SASB. We also analyze our climate risks and opportunities in line with the MAS Environmental Risk Management Guidelines, as well as also the TCFD requirement disclosure as well. And we have also formed the Sustainability Committee to actually look into this governance structure for the sustainability efforts that we have, which is actually chaired by our chairman himself. So the board takes a very strong view with regards to this particular aspects. We have started integrating this into the our business strategy, and hence that's why you see the collaboration that just came up and we have reported. Next. I'm coming towards the last few slides here. I guess in terms of the market outlook, we do see that the UK economy has rebounded after reopening, and it is now above the pre-pandemic level. However, as we know, the geopolitical uncertainties, like what Geoff has mentioned earlier, the Ukraine crisis, the high inflation, etc., are all expected to weigh on the economy this year. Now, inflation has rose to 7% in the 12 months to March, and it is actually the highest level since 1997. And the government and also the departments are also expecting that there will be a further increase in coming months, and it could actually goes up to 8% in the second quarter. So to compare this particular rising prices in the UK, the Bank of England has also in March hiked the bank rate by a further 25 bips to 75 bips this year. So next. This chart shows the performance of Elite Commercial REIT against the both the STI and the S-REITs. I would say, I guess, with regards to the S-REITs index, we have always been outperforming that since the point when we listed on the SGX. We will continue our efforts and outreach to various forms of engagements with the investment community, just like the one that we are doing with SIAS today. And we will continue to do that. And hopefully that will create more awareness and eventually helping out in the liquidity of the stock as well. Next page. So looking forward, the manager will continue to focus on delivering sustainable returns to our unit holders. We endeavor to realize the opportunities for growth via value-enhancing acquisitions. Well, we have got the ROFR pipelines from our sponsors, which we are looking at. We also have the open market supply that we focus on as well, because in the UK, assets that are used by the government are actually quite widely and well traded. We will also incorporate sustainability considerations in our overall strategy. And in any acquisition moving forward, we want to make sure that our portfolio remains relevant. So we strive to improve the REIT's prospect with future income and capital growth as well. So I guess with that, it comes to the end of my presentation. We will go into, I guess, the Q&A session. Zach?
Thank you, Charlene. Okay, we'll move on to the Q&A session, and I would like to invite Mr. Benjamin Goh, the Head of Research and Investor Education from SIAS, to join us as the moderator of this session. Alongside, we also like to invite Mr. Joel Chia and Mr. Jonathan Edmonds to come on to join us as a panelist. So if there's any questions, please feel free to reach out to us. We have a Q&A function at the bottom, so please use it to raise any questions for the panelists. With that, over to you, Ben. Thank you.
Thank you very much, Zach. So very warm welcome to Sheldon and your management team. Always very grateful for Lease to come and talk to retail investors. As you can see, we already have a couple of questions in the panel, the Zoom panel. But we're going to start with the pre-submitted questions, again, from retail investors that were submitted over the week or so. So we'll just start with the first one. So what is the impact on the distribution per unit of the additional CapEx spending that was announced along with the termination of the break clauses? I guess the idea here is that if Elite REIT is spending money on building out its asset base, then how much does that contribute to the DPU going forward?
Okay, I guess Joel will compliment definitely on this point, but be assured when we structured this, we have considered the DPU aspect. So it has been quite innovatively structured to ensure that we will continue to be able to pay out the dividends that we have been paying to unit holders. Maybe Joel, elaborate a little.
Yeah, sure. So the way how we structured this contribution, that it's not a contra revenue item. So it's actually considered a form of capital investment and will be capitalized as a cost in the balance sheet. So what happens is that the only thing that drags on the DPU would be the funding cost of it, which is additional loans you take to fund the contribution. And also maybe if, let's say, for example, we fund it out of the DRP proceeds, then it will be due to the widening of the equity base. Otherwise, the overall top line revenue and the underlying bottom line distributable income will remain largely stable because the amount that's being funded is quite minimal from the entire portfolio perspective. Yeah.
Okay, that sounds good. Yeah, so retail investors, one of the prime motivation of investing in the REIT is basically for the dividend play, right? So that's gonna always have to prepare for that question. So that's good. The other question is about institutional investors. So by and large, some of the REITs listed in Singapore, especially the ones that have got Capita in the name, like Capital More Trust, whatever, usually have got institutional investors. So one of the questions here is any plans to I guess, attract an institutional investor to invest in the REIT?
Okay, I guess, yes, definitely. That is always on our mind. But bear in mind, our main investor onto the REIT in our REIT register today, or the largest investor, which holds more than 20%, is actually Partner Reinsurance Company. So it's a European reinsurance company that has actually invested into the REIT itself. They are not part of the manager, they are a pure investor. So yes, we do have some institutional investor, but having said that, we are cognizant that the liquidity of the stock is not as vibrant as a lot of the bigger REITs. Hence, it's always our objective to grow the REIT further to attract more institutional investors as well. So yes, to answer that point, we would want to, and we are still working on. There's no change of directions in terms of plans on growing the REIT, and hopefully with that, and also with more understanding of investors on Elite Commercial REIT, we will be able to garner both not only the retail investors, but also institutional investors' interest in the portfolio itself.
Okay, just to add alongside that, your portfolio is 100% based on UK property, right? Is that a factor in terms of having institutional investors invest in the REIT?
I mean, do you want me to take this one, Shaldine? I absolutely wouldn't think so. I mean, there are plenty of UK-based institutional investors who invest in UK-based real estate. In fact, there are plenty of, I think, Singapore REITs, CDL, Suntec, et cetera, where they've got quite considerable exposure to, and Fraser, where they've got considerable exposure to UK real estate. So it's certainly not a factor. I think from our perspective, it's just the size of the REIT, the liquidity. So as we grow, we'll garner more institutional interest. It's as simple as that, hopefully.
Okay, great. There is another question back to DPU. What is your DPU guidance for, I guess, the rest of the year? Would it be similar to 2021?
Okay, so I think DPU forecasts generally REIT managers don't give them ahead of time because you don't want to front run selected market or investors. But I guess for Elite Commercial REIT, as you can see that most of the lease events have already been managed and the outcomes are positive. So overall, I would say that the top line revenues will be very stable for this year, with some exception to some vacancy that will be taking place in the form of Sunderland and Dundee. In terms of the biggest cost item, borrowing costs, while we do see that the banks are BOE is hiking rates in the UK, and correspondingly our margin, our benchmark that we are relying on has increased along the way. But we want to assure investors that majority of interest rate exposure has been fixed. So in other words, the real impact of our borrowing costs will be relatively muted compared to the real movements of the benchmark. So overall, I think top line stable, borrowing costs as an item and inflation stuff like that are still pretty much manageable. So I think overall the going forward distributable income in the next coming quarters would be stable as well. Yeah.
Okay. All right. Sounds good. Okay. So you mentioned about the CPI as well as a fairly large proportion, I think about 63% of your debt load, I guess, is based on a fixed interest rate, right? And currently you're paying about 2.2% as the cost of funds. So related to that is, so the question is, again, in your presentation, most of your tenants, or rather all of your tenants have got I guess, a step up, a tiered rental reversion scheme, right? So if the CPI goes up and then, the rents will go up, and that's good for investors. I noticed that the ceiling is 5%, but later on in the presentation, you mentioned that the CPI or the inflation in the UK might go up as high as 8%. Would that represent a somewhat, I guess, a large risk factor for Elite?
It's probably not a risk factor. What it just meant is that when it goes up to 8%, we won't get an 8% uplift. We get a maximum of 5%. So similarly, it also cushioned us during the COVID period when the CPI actually goes below 1%, and we get a minimum uplift of 1%. So that works both ways.
Okay, and I always like to joke around with the retail investors that, if the inflation is, well, it's now currently at 5 to 6%, but the fixed deposit is still 1%. So you're still very far below. So, doesn't really matter where you invest in, as long as it's a long-term, I mean, it's a good long-term investment. All right. Okay, so those are the pre-submitted questions. I'm just gonna go through some of the questions that came in through the Q&A panel here. Okay, there is a question about the rental increase every year. So apart from the rental reversion that's pegged to the CPI index, I suppose, is there any other built-in rental reversion that you have with your tenants?
I guess what I can say is that majority of these are actually structured the way that I've mentioned earlier. So as you can see, that constitute to, I think, the major part of our leases. There are one or two that is actually based on the market rent escalation. So, but they are not affecting the majority part of the portfolio. When I say majority, it's probably close to 90% or more about the assets. So in terms of year-on-year rental escalation, now the structure is such that it's compounded every year. So the leases were all signed back in 2018. And then what happened is that instead of increasing the rent every year, it actually compounds. So that's why I'm said that from, since we have locked in about 10%. That is based on the actual reported CPI over the past 4 years. So the new rate will only kick in once, which is at the 5th year of the leases. So that means it starts on the 1st of April 2023. And so that's why it's not an annual increase, but it's actually compounded, and it will reflect in the 5th year. Thereafter, the same rental rate will last for the next 5 years until the lease expiry.
Okay.
Yeah.
So if I understand this correctly, if at the end of the year, UK has got a CPI or rather inflation 8%, that will compound on top of the cumulative 10% that you mentioned.
Yes, that's why in our chart we have shown just now it's between 11 to 15.4%. Why is 15.4 and not 15? It's because of the compounding effect.
Okay, I understand. That's actually pretty good, right? Because I mean, obviously inflation is going to be high this year, but may not be so high next year, so on and so forth.
Exactly.
But you have already locked in a relatively high number. So, pardon my French, okay lah, 可以吗? Yeah, 可以啊，很好嘛. Okay, so okay, so jokes aside, just moving on a little bit. So another question is about the gearing. So the gearing in the presentation, the deck was 42.8%. So one of the questions would be, I guess the perception here is a little bit high. So any plans to bring it down?
Okay, I can take this.
Okay.
It's actually okay, so I think let's go back to gearing 101, right? It's basically total debt over total asset. And for REITs, investment property forms the biggest portion of the total assets as a balance sheet item. So as you will recall that in our last valuations conducted as of 31st December 2021, at that point in time, the valuers didn't have the benefit of this positive this week event that has materialized in the last 1-2 months. So therefore, we would say that we will guide that the current gearing is a temporal blip on the upside, slightly elevated blip upwards. So that's the reason why the manager has already announced to the market that we will be commissioning mid-year valuations, so that we will look at the IPs to be reflecting the proper intrinsic value that it carries. And thereafter, with that, with the revised set of valuations factoring in some of the positive lease updates that we have, we believe that the gearing ratio will be more managed. It will be less elevated. Yeah.
Okay, so so this 42.8% is in a way is just related to the high base, or rather relatively low base, right? Because
Correct.
the asset value is relatively low, it hasn't been revalued up yet.
Yeah.
Yeah, I understand.
So I think that would be a good way to look at it. So of course, over the long run, we have always been educating investors that the manager takes a very serious approach towards capital management. Our mid to long term goal is to make sure that our gearing limit is below 40%. We think that is the safety mark. So we would endeavor to reach towards that in the form of whether is it future fundraising activities or via via other methods to manage the gearing position. Yeah.
Okay, but if I'm hearing this right, after the revaluation exercise, this gearing ratio should mathematically come under 40%.
Cannot forecast, but it will be better.
Okay.
Yeah.
Okay.
Yeah.
And again, for folks out there, one of my ex-bosses used to say you cannot expect 5-star fresh food by paying hawker center prices. So obviously, if you want Elite REIT to grow, there has to be some gearing, and it's kind of nice to see that the interest coverage was about five times, right? So that's 5x, right? So that was pretty reassuring as well. Okay. Next question, is there a dividend or capital gains tax? I guess this is from the perspective that all the assets are in the UK. If yes, what is the rate?
Yeah, okay, so simple answer, we frank tax exempt dividends to unit holders. So as long you are a retail and investor in Singapore, don't worry about tax. Everything goes to you tax-free. So, but if for those who want to know a bit more, what happens is that we have embarked on quite an innovative restructuring program to streamline the tax structure of the vehicle, and we also protected and future-proof the structure from the movements of UK corporate taxes. So what we did is that we have actually a UK REIT group below the Singapore REIT. So we get the benefit of what a UK REIT group in the UK would have gotten. Instead of paying UK corporate taxes, we only need to pay withholding tax on equity dividends that's paid from UK to Singapore. And that withholding tax amount, the headline rate is 15% after a double tax treaty agreement between UK and Singapore. So that compares favorably against the headline tax rate of headline tax rate for the UK corporate taxes of 19%, which is going to go up to 25% in April 2023. So what we have done is we have brought the headline tax rate down. We have also protected the vehicle from vagaries of the future tax hikes. So overall, once all those are done, the money reaches Singapore, it will be franked as tax-exempt dividends to investors, and there shouldn't be any further taxes on their dividends. Yeah.
Okay, so just to give a little bit more color to our friends out there, the withholding tax, if you were to invest in the US equity or stock, is 30%. No questions asked. So obviously this is better, relatively better in the particular sense. So related to that question again is currency conversion risk from pound to SGD. How has that been performing since IPO? Are we gaining or losing in the dividend declared after the currency conversion?
Okay, I think I have to first say that the REIT manager's job is to manage the real estate and manage the finance prudently. One of the things we can't manage is the global FX movement. Okay, so but it's just for the interest of unit holders. When we went for IPO, the GBP SGD major was, I think that currency pair was about 1.76. At the peak of the strength of the pound during the period from IPO to today, it was, I think, about 1.86 or 1.88. I can't remember offhand. Today, I think there was today when I checked it, it was 1.73, which was lower than IPO time. But as you can tell, these are subject to the vagaries of the macroeconomic situation, the ongoing war, and on top of that, there's some flight to safety where a lot of people actually go towards USD, and Sing dollar actually packs very close to USD. So when USD strengthens, Sing dollar strengthens accordingly as compared to other currency pairs and majors around the world. So I think not forecasting anything, but I think what we have seen is that the pound currently is under a little bit pressure compared to Sing dollars, but it's actually a more geopolitically driven event which will correct itself. We believe once the uncertainty and war is over. But from where we are coming from, I think what we can continue to do as a REIT manager is to continue to perform by managing the assets properly and deliver a stable DPU return. And that's what we have been able to do so thus far. Yeah.
Yeah, so maybe just add on candidly, I think, compared to that, we have been paying a dividend rate of close to 8% on our REIT itself. So hopefully that compensates a bit in terms of the Forex exchange that we were talking about just now.
Yeah, certainly want to echo that. I mean, unless you have got $100 million invested in Elite REIT, I mean, a small change in the FX is not really going to affect your dividend at the end of the day. So folks, don't worry too much about this. Yeah. Okay, so moving on, what is the sensitivity of the DPU to rising interest rates? I don't think that was covered in your presentation.
Okay. Actually, I did a simulation. At least I got my team to do a simulation when I saw the question. So basically, if we assume 100 basis point increase in the benchmark rate, which is SONIA, which we depend on, that means that, for example, current SONIA is 69 basis points. And if we assume that the SONIA increased to 169 basis points, that will have a 3% DPU impact. That means your DPU will be declined by 3%. The impact is mitigated by the fact that 63% of our interest rate exposure is fixed. So hopefully that addressed the question somewhat. And for all intents and purposes, we don't expect SONIA to increase by 100 basis. Yeah.
Okay. All right. Next question about your corporate structure. Any guidance on possible near future rights issues?
Yeah, I can take this. I guess it is responsible for the REIT manager to assess the funding options at the point when there's a corporate action. So anything we say today is a bit of like crystal ball gazing and might not be a responsible statement to me, but rest assured that like what we have demonstrated in our maiden acquisition, at the point in time, the manager has assessed that the share market wasn't that, the unit price market wasn't that stable due to the COVID recurrence. We have taken the step to have a plan B to actually complete the transaction using internal resources. Similarly, going forward, for all fundraising exercises that we do, we will actually contemplate and think through clearly exactly what is the suitable funding option catered to the market at that point in time, especially given that we have, as what you have seen, like you have seen movements in the FX, you have seen movement in the share price market. So we can't say that a particular solution that we contemplate today could be applicable 3 months down the road. So we have to assess along the way. Yeah.
Okay. I guess the rights issue question is related to the capex or expansion of your asset base. So I can't remember whether that was actually addressed in the presentation deck, but perhaps some guidance about the overall London property market and.
Yeah, sure. I can take this one. I mean, the market in the UK is sort of split into various segments, with some parts of the market performing extremely well. Particularly industrial, particularly logistics. Offices in central locations continue to perform well from an investment perspective, as demand from all over the UK for UK commercial offices. In London, like there have been in lots of other large cities around the globe, there's been an increase in leasing activity as people have come back to work, and that has led to quite significant rises in rental rates, particularly in the short term. Just because there's so much transactional activity occurring at this point in time. It remains to be seen once that transactional activity kind of moves back to a more normal level, what will happen to rents and vacancy rates. And there are still questions to be asked about how many people are going to be actually ending back at work full time in an office rather than continuing to working from home. So there are a few pressures there. But as it relates to our portfolio, we collect our rent in full and on time. We've got sort of between 10 and 15% of rental growth coming through next year. Our tenant is moving more people generally into working, within offices in our portfolio. So from our perspective, that's good. And London continues to perform relatively well, and there are some parts of the market that are performing less well, namely sort of retail, shopping centres, etc. As those kind of operations are becoming less important whilst people shop online.
Okay, thank you very much for that. I suppose for the finance industry, the city is coming back, right? I mean, like the bankers and all that, and they're not moving out to Frankfurt or what have you. That was fear a couple of years ago.
Yeah, I mean, I think that was, certainly the finance industry, one of the groups where it's been surprising how, how possible it was for people working in the industry to work from home. So actually, some of the larger banks in some locations in London, taking a bit longer to come back, but. For those groups, they're always going to need a corporate office. There might be some rationalization of space, but ultimately, the vacancy rates in central London are still relatively low. So then, as it relates to Brexit, and people moving offices to Frankfurt, seems to not be spoken about so much at the moment. There's other things on people's minds. So, but there's definitely still the case that. A lot of people went back to their home markets after the pandemic, and it's just a question of where people will settle back once it's easier to travel around the world as we used to.
Thank you very much for that. Okay, one last question. So this is about the lease breaks that were exercised. So some of the tenants moved out to other locations. So the question here is, what are some of the possible reasons why they moved out? Was it because of cheaper rent, or because they closed they closed their offices in the particular building or in the UK?
Yeah, I mean, I think the different government departments have different requirements, and we've got a large portfolio of 155 buildings. The tenant themselves, the main tenant, operate out of 650 buildings at least throughout the UK. So in the majority of cases where they have moved out, it's because they no longer have an operational requirement for office space in that location, so they're closing down operations in that sub-market rather than moving to either cheaper or better space. So it's for a variety of different reasons, generally because the tenant no longer has a requirement for that property, rather than we're losing out to our competition.
Okay. All right, that's a wrap. Those are all the questions that we have that was typed out in the Q&A panel. So thank you very much for all the candid responses. Again, very grateful that you guys have managed to spend some spare time in your very hectic schedule to talk to the retail investors. Always very grateful and appreciative of that.
Yeah, we're always very happy to engage with our investors in all forms. So so happy to have this session as well.
Yeah. So usually when we have a REIT come online as a speaker for our corporate connect, I always try to push my luck by saying maybe I should go and visit your property one of these days. But I mean, obviously that can't be said in this particular case. But it's always kind of nice, for some of our members or the analysts to go and visit the portfolio properties.
Yes.
All right. Okay, let me save up on my frequent flyer miles. Okay, so thank you very much, Sheldon, Joel, as well as Jonathan. So over to you, Zach.
Thank you, Sheldon, Joel, Jonathan, and Ben for an insightful Q&A session. We have come to the end of the event for tonight. Thank you everyone once again for joining us this evening. In case you missed any part of today's session, you can actually rewatch the webinar on SIAS YouTube channel. And Corporate Connect is a bi-monthly webinar, so do visit our website to get updates on our upcoming investor education programs and initiatives. The upcoming Corporate Connect will be featuring Far East Orchard on the 10th of May, and we look forward to see everyone during our next session. Thank you all and have a great long weekend.